And that's where working with a CFP comes in. Identifying what that window of opportunity is.
Right.
You had mentioned the headroom within that tax bracket.
Your point on the where we are with current tax rates and where tax rates are headed, no one can say with complete certainty where tax rates will be in 10 years.
Right.
But when you look at the current deficit, when you look at our debt, when you look at our nation's spending and where rates are at right now and the shortfall.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement.
My name is Matt Landon. Welcome to the Semmax Way. I am joined by Mr. Jordan Shinsky in our office, CFP extraordinaire.
Glad to be here.
Glad you are here. Now, today, I want us to talk a little bit about something because summer is pretty much gone. It's August when we're recording this.
Yeah, it's about over.
What are you thinking? How's your summer been?
Well, it's gone by too quickly. My son's a senior in high school this year, so we've been doing college planning and everything else, and that really speeds up the entry into the fall. So at this point in time, my head's already into pretty much next year rather than just, summer of this year at this point.
So you're not just thinking about school as far as like, okay, school started, we're back in school. You're thinking about getting him to the next school and kind of moving forward.
Right.
Well, I think that ties in perfectly with what we're talking about today, which is future planning.
That's it.
It's easy to think, okay, it's still hot as the dickens outside, but we're back in school, regular grind, get after it. Don't really need to think about taxes till January, February when the forms start rolling in. Maybe if you're one of those people that likes to think ahead, you're thinking maybe taxes end of December. What do you think people should be talking about today, right now? What do we need to be thinking about?
Taxes and everything else, your financial picture. We're at a transitional point in the year where there's been a lot of distractions over the summer. There's going to be a lot of distractions as we move in to speed up the end of the year. Remember, August is already month 8. I know it still sounds like you said, it's hot outside, like summer's still here, but the end of the year is approaching quickly. There are things that we have to make decisions on as to whether or not there are certain strategies we can take advantage of, really advantages of, planning for 2027 and even like later into next year and years ahead at this point in time that have to start today and have to start now.
And I don't think the point here is to say it from a panic perspective. It's not like, it's more of like, there's opportunities.
Yeah.
Don't leave them on the table.
Well, don't procrastinate either.
Right.
How many times do we have conversations with someone who calls 2 weeks before Christmas and says, I think I need to take an RMD and I missed something somewhere, right?
Yeah.
So we don't want to have that happen.
Well, and I had someone who came in and the whole reason we sat down and talked is because they wanted a tax review done and we went through their tax returns. We also went through their investments and they did not realize, they knew that they could have been more tax advantaged, but they didn't realize how much things that they had done the previous year were going to affect their Medicare premiums next year.
Oh, yeah.
Like it's into the future.
We'll talk about that a little bit. Yep.
Well, I think one of the things that I want to close the loop on something that Kyle and I talked about last month, which was really around paychecks. And it had to do with retirement not just being a number. It's a paycheck that you have to build it. And if you listen to that one, maybe it landed, maybe it didn't. But when you think about that, Jordan, what would you tell folks to do on that side?
In order for us to have a conversation on the next steps that we're going to tell you, these 5 action items that we can take, you got to start with your income. You got to start with identifying your sources of income. And it's not just, like you said, it's not just a number. It's more so about the type of money that's coming in, how it's being taxed to you, how you're receiving it, the frequencies, the amounts, where it's coming from, and things of that nature, because they may or may not have an impact on other secondary or tertiary decisions down the road. Okay. So the first thing you have to do is identify the sources of money.
And so do you find it's easier to just go through and think off the top of your head? Or do you find it's better to look at your bank account and say, okay, what kind of big inflows have I had? Because it's different when you're working. And it's like, well, obviously I have my paycheck.
Yeah.
Versus in retirement, you've got Social Security.
Yeah.
You've got maybe your spouse's Social Security. You might have an annuity paying you income. You might have a pension. You might have distributions from an IRA account or from a non-qualified account or a combination of the above.
I harp on this a lot, and this goes into a bigger picture than just the income aspect of it, but you got to put pen to paper.
Right.
I'm kind of old school and traditional about it. Write it down, identify your sources of income, but not just your sources of income. For the purpose of writing it down, we're also talking about budgeting, cash flows, expenses, right? Where's the money coming from and where's the money going? For the purpose of this conversation, we're talking about the inflows.
Yeah.
How many times have you sat down with a client and, most of the time, us as individuals know where our money's coming from. Okay, I got $2,000 a month from Social Security. I got $1,000 a month pension. Maybe I ought to take $5,000 or $6,000 from RMDs this year. I know what those numbers are. Then all of a sudden, what your wife got. And that's part of the big picture as well. It's a household, right?
Totally.
All of a sudden they said, well, she gets like $1,400 or $1,500 from Social Security. I'm not really sure. We've got a handful of, 3 or 4 rental properties. She manages those. I'm pretty sure we were getting like $5,000 a month or so, but then she raised rent. We lost a tenant. Things changed. I'm not really sure.
I think
right?
we can do some of that. So I don't know how that affects my tax return.
Right.
And also, we've got some money in CDs, and those are 3-month CDs.
What's that going to generate for me? Right.
I think that's the part of the income that people start to miss is like when you start thinking about everything that's hitting your tax return, taxable income, because there's the what am I living off of every month income?
Yep.
And then there's also what's going on my tax return?
So to speak, almost more miscellaneous stuff that people just close their eyes or just turn a blind eye to. Yeah.
Well, and I think it helps because when we say like the first tip of these tips is really know your income picture, and before you can do anything else, you need to know your income picture because there's a couple big things that people like to do a lot. And one of them is Roth conversions. Yeah. Right?
Yeah.
But it's like, what do you tell people when they say, should I do a Roth conversion?
Well, there's a bigger conversation to that, right?
Yeah.
So, and this is kind of step 2 in the process of what we're talking about here. The idea of Roth conversions are when you look at the buckets of retirement money that we work with, typically within our financial picture, there are 3 buckets of taxable money that we see. There is the tax it now, which is your earned income, stuff, your payroll and stuff like that in your working years.
Right.
There's the, that money is the stuff that goes into your checking account. That's taxed differently. The growth, the future of that money is taxed differently than retirement money when you think of your traditional 401k or an IRA account, right? That's money that I haven't paid a penny of tax on that money. I've earned it. I've invested it. It's grown for the last 20, 30, 40 years. Now the taxation of it ends up occurring when I draw it out in retirement for the use of it. That's taxed as ordinary income. Okay.
Right.
The third part of it is Roth money. So you were talking about Roth conversions. Roth kind of functions the opposite of your traditional 401k or IRA. If I earn $100,000 a year, I'm being theoretical about this, and I contribute 10% to my traditional 401k program, I'm moving $10,000 a year to my retirement account. I'm only paying taxes on $90,000, right? Now, on the flip side to it, I take that same $100,000 in income, but I contribute $10,000 to a Roth 401k program. I'm still moving $10,000 into it, but all $100,000 that I earn is taxable in the year that I earn it. That $10,000 still goes in. It's still gross tax deferred, just like the 401k program, the traditional program. But when I draw it out in retirement, qualifications, of course, being primarily I have to be at least 59 and a half, and I've got to have at least 5 years of seasoning within that account. But with those qualifications, that money, not just the principal that I put in, but also the growth aspect of it is tax free.
So here's the thing with that is there's 2 ways money goes into that Roth account. There's contributions, which is what you just described. During your working years, you're contributing earned income into either a after tax, which rolls into a Roth from a 401k, 403b, or making contributions directly into a Roth account. The other side, the other way you can get money into a Roth account is conversions.
Right.
And that's scooping money out of that IRA bucket, going ahead and paying the taxes on that portion, putting it into the Roth.
That's the key part of it, right? Is that it is reportable as income in the year that we do the conversion.
Correct.
So if we're looking at, there's a lot of aspects that we have to take into account, right? There may be benchmarks around Medicare premiums. There may be benchmarks around this new standard deduction on our Social Security taxes, right? Income limits, tax brackets, the progressive tax brackets that we may want to either take advantage of or avoid being exposed to.
And seniors that are in the right age bracket for this being over 65,
correct?
They're getting that enhanced senior benefit.
Oh yeah,
additional $6,000 per person. Of course, it phases out if your income goes too high.
Yep.
So that also factors into the question of should I do Roth conversions now versus later, or how much?
Yeah.
And whether you are 63 versus 67, you might say, well, we're both doing the standard deduction, but you have different deductions.
Right.
It's a different limit.
Right. It's not just a single Roth conversion conversation. And this is why I say when we're talking about income and the strategies that we're discussing down the line here, everything flows from that income conversation. Everything is impacted by it or impacts it down the line.
So point number one is you need to know your income.
You need to know
your
income.
taxable income, but because when we talk about income, so much of the time it is around cash flow for monthly expenses.
Yeah.
And this is more teed up on your total income and your tax return, your taxable income. And how does this all come together? Capital gains
And
strategies.
Right.
And then the second thing would be around that Roth conversion timing.
Yeah.
Should we do it? Should we not?
Yep.
If so, when?
Yep.
How much? Right?
It's a popular conversation that we have with a lot of folks. And here's the thing. In your working years, a lot of people end up contributing pre-tax money to the retirement plans because they're looking to reduce their tax consequences today. When I'm 30 years from retirement, if I have a way of reducing my annual reported income to be taxable by $10,000, I'm going to find a way to do that, right? If that means using pre-tax contribution, that's great. Now, all of a sudden, you're 30 years down the road, I'm looking at retirement or I've entered retirement and I'm saying, boy, I wish I had that Roth bucket of money. That would have been great to have now.
Well, I think there's a lot of people that have been told, and I've had some folks that have come in and they weren't clients yet, or some folks that are clients, and they feel a sense of anger. Because they feel like I was always told my taxes would be lower in retirement.
Yeah.
Now I'm in retirement and they go, wait a minute, I'm on a fixed income. I'm only living off of what I've saved. I did a good job of saving. I did everything right. Why is my tax bill higher than ever?
Yeah.
How does that work?
Well, and that goes to show that there are no guarantees as to what our tax consequence is going to be in the future. Right now, we are in a pretty favorable tax environment.
We are.
Okay, at least for the short term. We don't know what that's going to look like 2, 5, 10 years down the road. But the buying power of your money, when it has to be taxed at what could be an unknown rate down the road, doesn't mean you have that buying power of what your portfolio says it has.
Well, and I think that's because we can talk on about inflation as well.
Yeah.
But I don't want to lose this thread real quick, because one of the things with Roth conversions that I think is so key is not necessarily converting every penny. Right. Converting as much as we can. How much does it make sense to do? Why would we want to do this much? And really, I think that there's an aspect of this that is not just for yourself.
Mm-hmm.
There's a piece of it that is, especially if you're married, for your spouse.
Yeah.
Because that you go from that joint tax bracket to a single tax bracket. Mm-hmm. And you can almost think about that Roth account as an emergency account to keep their income down further down the road. It's not just about, am I going to reduce my taxes this year? Because the reality is that yes, we might have some room. You have that gap. You've got that room inside of a tax bracket. You say, well, we can do this much and stay in this tax bracket.
Yep.
Okay, that's great. But the thing is, you are objectively paying more taxes today.
Yeah. When you do that conversion, it's just you kind of that's where working with a CFP comes in. Identifying what that window of opportunity is.
Right.
You had mentioned the headroom within that tax bracket.
Your point on the where we are with current tax rates and where tax rates are headed, no one can say with complete certainty where tax rates will be in 10 years.
Right.
But when you look at the current deficit, when you look at our debt, when you look at our nation spending and where rates are at right now and the shortfall, I think a lot of people are feeling like it's going to be higher. It has to be higher. There's a lot of people feeling that way. So with that in mind, that Roth conversion, you're basically taking that hypothetical of that unknown tax bill and you're making it a concrete in today's rates.
Yeah.
Yeah.
In 10 years from now, if I've got Roth money that I've converted, do I care what those tax brackets are? Not as much, because that money it's not impacted by it and it doesn't have an impact on it.
What's your opinion on trying to move everything possible, or do you think it's situation? Obviously, it's going to be somewhat situation based, but do you feel like there is a certain goalpost that people should have as far as like, I really don't want more than X in an IRA, or I don't want to convert more than X? Is there anything like that, or is it entirely dependent?
Within the 3 classes of taxable money, we look at it as trying to level the playing field. So we try to get a blend of all 3. Here's the difference, and that's just a starting point. The goal of the client and your intentions with your money is really where it becomes important to have that conversation with your financial professional. Understanding that Roth money in and of itself doesn't just create that tax incentive for you as an individual in your later years. And you talked about passing of the first spouse, right? And having that a less burdensome tax situation for the surviving spouse, but also for that estate transfer of funds. Your wealth transfer to heirs. Maybe you say, well, I want to leave as much money to my kids that I can without a burden to them. Then you probably want to be a little more heavy on the Roth conversions because you want to have that ease of transfer without that burden falling on them of taxable income when they get it.
Versus somebody who's planning on leaving all of these funds to charity.
That's true.
You may say, don't do any Roth conversions because all of that money that's going to taxes, that could be still growing in the market.
Yeah.
And if you leave it to the church
there.
or if you leave it to an animal shelter, they have that exemption as long as it's a legit 501c3.
Oh, yeah.
Right? You can't say my kids are my charity. That doesn't count. But it's like that's a perfect example of something where it's like Roth conversions are a tool.
Yeah.
But it's not the right tool for everyone.
That's right.
So let me ask you about point number 3.
Okay. Which
really gets into RMDs. And the argument is that really RMDs, they don't just end when the check is cut. Once you've received that RMD, it's not like, okay, magically that's done. Don't have to worry about it anymore. Problem solved.
Yep.
Talk to me a little bit about RMDs. And first, just give a brief on what it is for those who don't know.
Okay.
And then we can get into things beyond there.
So RMD stands for Required Minimum Distribution. Okay, this is the idea that when we had talked about the pre-tax contributions into our retirement accounts, the traditional IRA, the traditional 401k, that money which has been contributed, which has grown in value, and has now gotten to a retirement point without any taxability at all to it yet. There are some people that when they get to retirement, maybe I do have a healthy Social Security income. Maybe I have a pension. Maybe I have rental properties or a part-time job. And I don't necessarily need to draw from my pre-tax 401k or IRA. Well, after 30, 40 years, the IRS looks at that and says, you owe taxes on this money. We want to cut from it. Right? So they force you to start drawing this required minimum amount out of it at a certain age. Now, that age has changed over time. A few years ago, it used to be 70 and a half. Then it was 72. Currently, it's 73. And then a few years down the road, it's going to extend out to 75.
Depending on what year you were born.
That's correct. The basis of it is that they got to get their tax benefit from it. Okay. If you never use that money, if you never draw that money, you never pay taxes on it. And they say, we got to get our share, right?
I think there's 2 other things to this. And this is where I don't want to sound like a tin hat conspiracy theorist. But one, RMDs were instituted in 1986.
Yeah.
Okay. And it was 70 and a half. Well, everyone is going to take their Social Security. Who's going to take Social Security? They will do it between the ages of 62
and 70.
And 70,
right.
Somewhere in there. So by 70 and a half, everyone who is eligible and pulling from Social Security is going to be having Social Security taken out. In 1985 was when they started taxing up to 85% of your Social Security.
Yeah.
But they only taxed it if your income was over a certain limit.
Yeah.
And then next year they say, hey, you have to pull from your IRA. By the way, it counts towards your income.
Yeah.
Guess what? Not only can we tax your IRA, also we can tax your Social Security.
Yeah.
So that's part one. I think it was a way of causing more Social Securities to be taxed.
Oh, yeah.
But the other piece of that, and you're welcome to disagree. You're welcome to push back. Again, this is me being a little bit of a tin hat conspiracy theorist, but I do believe there's something to this because these things don't happen on accident. These bills aren't written by accident. I think there's a component of this that has to do with our social condition, which is that says, if I force you to do something, you'll do it and no more. Like with your teenagers, it's like if you tell the teenager, hey, I need you to do this and this and this, are they going to take it upon themselves to, if you said, I need you to mow the yard and edge everything, are they going to take it upon themselves, just also go ahead and blow off the driveway because you didn't tell them to do that? No, you're like, you're going to go back out there and be like, hey, blow off the driveway. And they go, no, you didn't tell me to blow off the driveway. You told me to mow and you told me to edge and I did it. And you're like, yeah, but you didn't do the whole job, right? I think we still have a little bit of that where it's like the IRS says you have to take a certain amount out and you go, fine, I'll take it out and I'm not going to take out anything else. And then what does it do? It's growing back pre-tax.
Yeah.
Next year, you got to take out more.
Yeah.
Fine. I'll take out just what I have to and no more. And then before you know it, you're 92 years old and you've been paying income taxes even though you've been retired for the last 30 years. right?
That's it.
As opposed to looking at it and saying, maybe we should strategically pull some of this out because that growth rate on it, it's like, even if I didn't have Roth conversions, after tax money, you can be much more favorable. Long-term capital gains, step up in cost basis to the kids, those types of things. But when you get into it, I mean, I think the RMD conversation, it's so much more than just, okay, the IRS is going to take our money this year, so let's not pay the penalty. Let's do what we have to.
There are strategies around it. Realistically speaking, when everyone gets to a point that they start drawing RMDs, most of the population that has IRA money is taking at least a little bit out to live off of, or whether it's, hey, this is my vacation money or something, they're drawing from it, right?
Yeah.
If you're not, there are strategies around, that's where we get into the conversation about QCDs and things of that nature, qualified charitable distributions.
Which is a way of not paying any taxes.
Correct.
Solving for that RMD.
Right.
And the full amount goes to the charity.
Right.
So I would argue personally, and I don't like to make a lot of blanket statements, but I would argue, and again, you're welcome to agree or disagree. I think anybody who is of 70 and a half or older and they're tithing to their church, if they have IRA accounts, I would argue you should not be writing a check and dropping it in the plate.
No.
We should be utilizing QCDs when possible.
Right.
Yeah.
The tax favorability of it, it allows the recipient to have more power in the use of the money. Right. I will say this as well as a caveat that while we're talking about RMDs, a lot of people are going to get this impression that if I'm doing Roth conversions, that'll satisfy the RMD, won't it? No, it will not. RMDs do not satisfy, or Roth conversions do not satisfy RMDs, even though it's a distribution from that qualified account.
Right.
It does not satisfy your RMD. So it's an additional step that we have to talk about even as well, the big picture, because if I have to take, $40,000 a year in RMDs, but then we were doing, $40,000 or $50,000 a year prior to that in Roth conversions, now that adds a lot more income that we're reporting. And again, we talked about kind of that headroom, those brackets, the IRMAA levels and stuff like that we may want to avoid. Now that potentially puts us even closer that we got to reevaluate our strategy.
And wouldn't you agree that there's also an aspect of some of the things that we're doing come down to semantics and order of operations? Because you say, okay, Roth conversions don't count towards RMDs, but your RMD is calculated off the first dollars distributed from your account.
Right.
So you can run into an issue with the IRS because you did a Roth conversion for 30 grand and then you took your 10 that you owed for your RMD the next day. It's like, you got to take that RMD first.
Keep in mind that the RMD is calculated off the close of business on December 31st, the last business day of the year. Mm-hmm. So that number doesn't actually, once that number is established, it doesn't matter what the valuation of it is. You're going to take it throughout the calendar year. But
we're going to have to take it.
Right.
But I know the timing. And this is where I think a lot of people will think about, maybe I'll do a Roth conversion if the market dips, but I don't take my RMD till the end of the year. And it's like, well, wait a minute. Yes, you could do both. Mm-hmm. And because there's other people that think because I'm of a certain age, I can't do this.
Yeah.
I had someone who said, well, I thought you could only do conversions when you had earned income.
No, that's not the case at all.
No, because the contribution, you have to have earned income.
Right.
But a conversion, as long as you got those IRA dollars, you can do it.
Yeah.
As long as you've already satisfied that RMD, you can do it.
Yep.
Now, I do want to talk a little bit about something that I think is very much so a hot button topic, and it's really around healthcare costs.
Okay.
Open enrollment window near the end of the year. We got a little bit of time until then.
Yeah.
Thinking about Medicare premiums and how that can be impacted by, again, thinking about your income and then into Roth conversions, the RMD impacts, and then your healthcare costs, they all kind of segment together. When you think about those costs, it says mid-October, early December. Why can't that just be a January decision or something like that?
So you mean as far as you making the decision on what your Medicare situation is, or the government's decision on what you owe them?
Well, I would say when it comes to people say, okay, I'm in retirement. I pulled income out. Maybe I did a larger amount than I was supposed to. I'm signed up for everything. And come January, my Medicare premiums jumped up.
Yeah. So this is the confusing part about Medicare is the timing of everything. It's a 2-year look back as to what my Medicare premiums are going to be for this year. Actually look two tax years back.
Why?
Because they use your completed tax return in order to determine your income levels and how much you will owe.
And this starts when you turn 65.
And it starts when you turn 65.
And not everyone turns 65 in October when we all have our tax return.
No, that's right. I mean, it's all throughout the year, right? You have to have that completed tax return for them to determine what you're going to owe in it.
So we're using the same tax return for everybody.
Yeah.
And if one person's birthday is in January, we don't have it.
That's right.
Another one's October. Maybe we do have it.
It doesn't matter because we're looking at the prior year.
So what you're telling me is next year in 2027, people's Medicare premiums will be affected by what they did in 2025.
Correct. So if maybe I bought a car in 2025 and I took a $60,000 distribution from my IRA to buy that car, right? One-time purchase, but guess what? It increased my income and all that kind of stuff. Now I get into 2027, I go, why did my Part B premium, my Part D premium go up, right?
Yeah.
Well, that's because I ended up in 2025, that distribution put me into what they refer to as IRMAA. That's that income related adjustment to my Medicare premium because you made more money than what they deem as you should be as a recipient of Medicare, right? So in some cases, it can be as much as double or even more because it is a bracketed system. So if I do this distribution 2 years ago and all of a sudden my Medicare premiums in January go up, I'm like, what caused this? Why did this happen? You got to look back 2 years to find out why.
And the really scary part about that for me is when you're not keeping an eye on this, you maybe it wasn't a one-time thing. Maybe it was you did too large of a Roth conversion.
Yeah.
But because you don't find out about this until 2027, you already did it in 25.
Yeah.
There's a very good likelihood that you're going to do it again in 26.
Yeah.
So it's like, it's not just a one-time thing. It can be a multi-year problem. And
you don't even know it's an issue.
Well, and I've seen folks that have increased their Medicare premium by over $500 a month.
Yeah.
And someone looked at me when I was going through this with him and he realized what happened. And he said, that's a car payment.
Mm-hmm.
And so that's one of the things, especially when we're talking about either purchasing a home or an RV or making a large distribution out of the accounts. I think it's important to look at tax brackets, but also think about your Medicare premiums. Think about the downstream effects because you may be better off breaking it up into 2 years and saying, okay, well, if I have to take a loan off of a piece of this, it's not about you don't have the money. That's not why you're using a loan.
Right.
It's about trying to maximize because let's say the mortgage is 7% on the second property, right? And we take that bucket of money you would spend to pay it off. You put it in something, let's say like treasury bills, making you 3.5% or 4% liquid, but you're like, wait a minute, I'm still losing money to interest. But if it keeps you from bumping into the next tax bracket, all of a sudden you're saving yourself 10% in the tax bracket area.
Yeah.
That alone is, well, now we're coming out 6-7 to the good.
Yeah. Or I've avoided IRMAA where I'm going to be paying more.
Tax on top.
It adds up, doesn't it?
And so all of a sudden you realize, wait a minute, by taking out a loan and paying 7% interest, I'm actually coming out 10% ahead.
Yeah.
It's kind of wild.
Oh yeah.
And this isn't to say everyone go out and take large loans and throw everything on credit cards. That's not the takeaway. The point is to say, to what you were talking about earlier, these brackets and how much room do you have?
Yeah. But even at that, like, okay, going back to the 3 taxable buckets of money.
Yeah.
Well, maybe we don't take from our pre-tax bucket. Maybe a one-time distribution like that, for a car purchase or a down payment on a home, maybe it does come from that brokerage money that I have in that non-qualified account. Maybe it does come from the high yield savings that I've been accumulating in the bank or in the credit union, right? It doesn't necessarily, there's different strategies. I'm not saying that it's either, well, you pay it in full or you take a loan, but there are different ways that we can strategize, taking those buckets of money that either aren't reported as income or don't have the taxability of income that you would assume by taking it from your retirement account.
Yeah.
So, yeah.
And I think when we get into that as well, I'm going to put my tin hat back on for just 1 second here, because the thing that really irks me is that you can calculate, okay, how much do I have to stay in the bracket? You add in the standard deduction, you fill it up right up to that. You say, okay, we left maybe $1,500 of room, a little bit of wiggle room.
Yeah.
And you blew through your IRMAA limits with Medicare by like $5,000.
Yeah.
I swear that's intentional. Why are they not the same number? I feel like they're looking for people because it doesn't matter if you go over by $2 or if you go over by $20,000.
Yeah.
If you're in the next, Medicare premiums go up.
Keep in mind that those numbers, they change every year.
True.
Some numbers only change with legislation. Some numbers change with inflation. So you have sometimes where, okay, that 22 to 24% bracket jump may be, it may be more than IRMAA last year, but now IRMAA goes up a little bit and all of a sudden now it's below IRMAA's number, right?
Yeah.
So that's the nature of why those numbers move. Granted, it makes it complicated.
I feel like you should be able to reconcile them.
Yeah.
I feel like this is one of those, when you know about it and you keep an eye out for it, it's avoidable.
Yeah.
But it requires us to do work for our clients on an annual basis. It's like you're always you can't just rely on last year. You always have to rerun the numbers. But two, it feels like it's an easy thing that trips people up.
Yeah.
Because there's not enough conversation around it. There's not enough knowledge around it. And I think really around those healthcare costs are going up. They're going up across the board. And so keeping that in mind, that's one of the biggest things that keeps people working until 65 that I found.
Is.
There's a lot of folks that have the assets to retire.
Yeah.
But they're going, well, I'm going to work until 65. Why do you want to work until 65? I don't. I need health insurance.
Yeah.
Like it's driving.
I don't know what I'm going to owe in the ACA if I have to cover myself for the next 2 years, right? It's just easier for me to work through it. Well, talk to a professional about it. Maybe you can retire. Maybe there are options, giving you a clearer picture of what that's going to look like and how much you need to fund it, right?
Yeah.
Where that funding comes from.
So I think people look at their taxes on an annual basis, at least a cursory glance. There's a document that people aren't really looking at. Maybe you don't have one. Maybe you do have it, and then you shove it in a drawer, and you hope you never have to look or think about it again. You know what I'm talking about.
Wills and
trusts. This is on the estate side.
Oh, yeah.
Absolutely.
Oh, yeah.
Wills and trusts.
Yep.
When was the last time you actually looked at your will and read it?
Well,
do you pull it out and just give it a glance every 6 months?
I redid mine 3 years ago when I moved, and
3
I
years
haven't
ago.
looked at it since.
Right.
Now, I do recommend,
most people can't answer that, right?
As a default, I recommend people take a look at their will without any significant changes to their lifestyle, to their financial needs or anything like that, about every 5 years.
Okay.
If something happens within your life that changes things, you got to look at it on demand. If I buy a new property, if I move, if a spouse is deceased, if even kids get married and divorced, right? That changes the dynamic of what your estate plan may or may not have. It may or may not have an impact on your decision making for your future, right?
Yeah, and I don't want to get into specifics, but I will say in general, the heart of what people are trying to accomplish hasn't changed, but maybe the mechanism should.
The strategies, yeah.
It's like how things are distributed, the relative values and disadvantages of using a trust. Those types of things should grow and change it.
Well, and even understanding. So this is a part of it people don't oftentimes put together under the same umbrella, is that your investment accounts, they typically have a beneficiary designation to them, right? So if I have my will designated, I just want my whole family to get my wealth, my money, right? But you have your 401k from work that 30 years ago you designated as your brother because you weren't married, right? That doesn't go through the estate process, through the will. That supersedes the probate process. So your brother is going to get a phone call that, hey, so-and-so passed away and this is now your money, when the intention of it 20, 30 years down the road was supposed to go to my wife and kids, right? So updating that and making sure that you're looking at your beneficiaries, making sure you're looking at your joint ownership, making sure you're looking at your will and your trust designation, right? Even your POA and things like that. Very important that you look at all those.
So I had a gentleman who came in, and when he came on board as a client, one of the things we did was we called his 401k company and made some adjustments, and we also called his pension. And when we called, we weren't planning on changing anything, but I have a checklist that I run through. One of the things I asked was, are the primary beneficiaries set up correctly? And because we're checking all of ours, and we just want to make sure it's right. Yeah. And he was like, yeah, it should be 50-50 to my son and my daughter. The pension only allows one primary beneficiary. It was set up 100% to his son.
Okay.
And he went, no, it's supposed to be 50% to my son and my daughter. And they said, nope, your son is 100% beneficiary. Your daughter is 100% contingent beneficiary. And he went, timeout.
Yeah.
It was like, and that's an example of, you want to look at some of these kinds of things and you make an assumption. things don't always get put in correctly.
Yeah.
We had a case where someone came in, their sister, her husband had passed away. She was grief-stricken, then got cancer. Never updated her beneficiary. She had her primary beneficiary, didn't have a contingent beneficiary, left everything in her will to her brother. She had over $940,000 of pre-tax money. And because he was not listed as the beneficiary, it had to go to her estate, meaning it all had to be cashed out. Anything over $16,000, they paid 37% federal taxes on. So right off the bat, tack on another 4% local.
Yeah.
So over 40% just disappeared.
Yeah.
And then because it went into the estate, you have to go through the estate process, the probate process, and then it gets distributed out.
Yeah.
Conservatively, just by not having a contingent beneficiary, there was an extra $240,000 in taxes paid.
Oh yeah. And possibly 6 months to a year before it was distributed.
Yeah. It's extra headache. It's extra paperwork. And it was ridiculous what it did from a tax perspective. Now, I do believe as a Christian, pay what you owe. Let's pay what we owe, right? Pay your taxes. Render to Caesar what is Caesar's. Jesus said it. I agree with that. And I hope this doesn't come across blasphemous, but I don't think Jesus intended for us to pay extra in taxes because we weren't paying attention.
Right.
It's like pay what you owe.
Yep.
But let's not pay 3 times that.
Right.
And that's literally what happened. So I think there's a little bit of a coordination problem. So talk to me a little bit about how these relationships are structured, because a CPA will talk to you about your tax return.
Right.
And what you did. Your attorney will help you with your estate documents.
Yeah.
A lot of financial advisors will manage your account.
Mm-hmm.
But the overarching theme here, because there's a coordination issue.
Each professional typically stays within their lane. Understanding, though, that our financial profile, our life profile is very intertwined in those 3. If you're going to ask your CPA about doing Roth conversions, he's probably going to tell you, sure, you can do Roth conversions.
And here's how much before you hit the next bracket.
And I mean, but that's the end of it. There's probably not going to be a detailed conversation about, well, let me take a look at your income. Let's take a look at everything else that's going on this year, because he's just going to talk about it from the perspective of your taxes, and especially from probably last year's taxes, right? Now, that doesn't take away the quality of a good professional. A good CPA is a good CPA, a good attorney, a state attorney is going to be a good estate attorney, but they're not going to cross into each other's professional landscape, right?
Yeah, and a perfect example of that is an estate attorney might say, hey, you can leave money to a charity. And you're like, okay, great, let's put that in our will.
Yeah.
If you go and ask your CPA, hey, I'm thinking about leaving money in my will to charity, they're not going to say anything about it because they're like, I'm not giving you legal advice on your estate planning.
Yeah.
That's their job.
Yep.
You ask the attorney, well, what's the tax advantage of doing this? They're like, I'm not giving you tax advice. I'm writing your estate documents. And your CPA, your CFP rather, should be sitting in the middle going, time out. If we give out of your IRA to charity, that's going to be more advantage. Your kids are going to walk away with more dollars in their pocket. We're going to save on taxes. No, I'm not doing your taxes. No, I'm not telling you exactly what your taxes will be.
Right.
But from a planning perspective, let's put these legal documents, your tax return and your investments all on the table together.
Yeah.
Because I do think about it like, do you remember when we did the team building exercise back in the spring?
Mm-hmm.
So we get in the office, we're doing all these team building exercises, and one of them was Legos.
Yeah.
Now, do you remember how we did that?
Yep. Where one person read the instruction manual and had to dictate to the person building what pieces were to go where.
Yeah.
Right?
Yeah.
It becomes a little more difficult than just looking at it, placing it, just mimicking what you're seeing on the page.
Yeah. But I feel like when you're doing that with multiple professionals that aren't communicating, that aren't working together, you don't have a comprehensive plan, kind of pulling it all together. It's like you've got one guy who's building Legos. You have somebody else who's trying to build Legos. You got a third person that's trying to do it. And you're the one trying to give instructions. And you're saying, okay, we're each going to make a third of these, but we're all pulling from the same bag.
Yeah.
And nobody knows, are you working on the wheels and the base of this car, or are you working on the chassis? And we're trying to coordinate it.
Mm-hmm.
And then you've got somebody who's colorblind trying to tell them which piece to use.
Yeah. Well, I think each professional, they look at it, there's going to be a prism of their their professional aspect that they focus on your lifestyle. Your financial advisor is just going to look at the growth, the risk, the demand and what your goals are for your money and the usage of it, right? I'm generating income. I want capital appreciation, whatever that may be, right?
Yep.
Your CPA is going to look at it from a tax perspective, and probably only a tax perspective. And your state attorney is going to look at it from a legal perspective. Having someone, and that's where the CFP really comes into play, is that looking at it holistically in how each of those professions interact with one another, because they're not isolated. The decisions that we make within our professional lives, each one is not isolated to that profession. The decisions that we make tax-wise with our CPA may very well have an impact on the money that we have and the way that it performs in our investment accounts with our financial advisor. May very well have decisions that change the way that it impacts our estate or wealth transfer strategy. Having a CFP to look at from the holistic approach to the big picture is what kind of puts them all into the room together and has a conversation around what is the best approach that is going to be
to help you reach your ultimate objectives
for the big picture, right?
Yeah.
So I think that's the benefit in it.
So let's do this, because I feel like those were the quick hits. Let's do a real fast bonus round.
Okay.
Real fast.
Okay.
Quarterly estimated taxes. What's the big deal with that?
As we get into the last quarter of the year, well, okay, right now it's quarter three.
We're doing this in August. What's the deadline?
September 15th is the deadline for Q3.
So if your income change, distribution conversion, you better revisit it before that payment goes out.
That's it. Things may change within the distributions and your income levels. You just got to make sure that you're accommodating that.
Okay. Flexible savings accounts.
Not quite as popular as they used to be. For those that aren't aware, a flex savings account is kind of similar to an HSA. Okay. It does not accumulate value over time. You use it within the course of a year. That's it. Now, they've recently made some changes to being able to carry over some funds and even extend the deadlines out a bit. But at the end of the day, if you don't use it, you lose it.
Okay, so you want to make sure
you got to revisit
the deadline. Don't
Correct.
wait until the end of the year.
Correct.
And there's certain things you can buy with that. There's certain things like you can stock up on toothpaste and other things.
Yeah,
a little bit of flexibility there. If you're going to lose it, let's look. Annual gift tax exclusion.
Okay, and this is a big one that we talk about with clients. So the nature of gifting to your family, whatnot. Now, this is not the aspect of gifting to charities or doing QCDs of that nature. This is about just gifting money to your family, to friends, whatever the case may be, on a non-qualified basis. You can do up to, and this year it goes up a little bit every year for inflation, but this year is $19,000 that you can gift without having to file a separate gift tax return. That exclusion limit is per person per year. Okay. So looking at if you're giving to your family, to friends, to wherever the case may be, and you're planning on doing so, just being aware. Oftentimes I see it with grandparents that are gifting money to kids for their birthday or for the 4th of July or for Easter and Christmas and all holidays and stuff like that.
Yeah.
Where maybe they're giving $1,000 here, $1,000 there. All of a sudden, hey, I want to give you $15,000 for college, right? You're going to school. I want to pay for your first tuition payment. But if you've already given, $5,000, you got to be careful what you're going to gift. Right?
This is where I think it's important to keep in mind, especially for those of you that are wanting to help someone with maybe the purchase of a first home or something like that. That $19,000 per person, that means a husband and wife, right? Married couple. The husband can give $19,000 to their son. Yep. The wife can give $19,000 to their son, right? The husband can give $19,000 to their daughter-in-law. Yep. The wife can give $19,000 to their daughter-in-law. So if you start adding this up, it's not even the $38,000.
Yeah.
Right? You start getting into it, and really, we're talking about $76,000 before we have to worry about that gift tax.
Yeah.
And especially if we're doing it around the holidays, you can break it up into 2 years and really, really maximize if somebody wanted to do that.
Right.
Now, I'm not telling everyone to give away hundreds of thousands of dollars or even $750,000, but if you want to do it, talk about strategies to make sure you're doing things appropriately, staying above board.
Yep.
Because the big thing is we don't want to get the IRS involved if we don't have to.
That would be bad.
Now, I will just say this. If you're somebody who got value out of this, that's wonderful. I hope you've enjoyed it. Jordan, thank you for being in here and talking through this. You're a wealth of knowledge. I always enjoy it when we get to do these kinds of things. But I will just say, for those of you that are listening, if you have a family or a friend, something along those lines that you think would value from this, please send them over to here. These deadlines, they're very real. There's different ones. Medicare enrollment closes December 7th. RMDs have to go out by December 31st. Roth conversions have to be done by December 31st. These aren't soft suggestions. These are absolutely dates on a calendar. Some of them take time to get in order. So on behalf of myself, the whole Semmax team, Jordan, those that you don't see behind the camera, because there is a whole team here that makes things happen. We just thank you so much for listening. I hope you've enjoyed it. And as always, be safe and have a wonderful day.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor respectively for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.